Before we begin, take a moment to like this video and subscribe to the channel, because what you are about to hear is not financial advice, not conspiracy, but documented reality that most people never stop to question. Every major financial crisis begins with the same promise. We're told the economy is strong, markets are healthy, growth is unstoppable. Then suddenly, everything breaks. Stock prices collapse, news anchors panic, companies start firing workers, families lose income overnight, mortgages become impossible to pay, credit dries up, fear spreads faster than facts. And while ordinary people scramble to survive, something strange happens behind closed doors. The institutions that cause the damage don't collapse the way people do. Banks remain standing, their doors stay open, their executives stay protected. This is where the myth of equal risk falls apart. Because in theory, capitalism punishes failure. In practice, it decides who is allowed to fail. And from the very beginning, the system was designed to make sure banks are not on that list. To understand how this protection works in the real world, we have to go back to 2008, because that crisis exposed the system in its purest form. In the years before the crash, banks aggressively pushed home loans onto millions of Americans, even when they knew many borrowers could never repay them. These were not accidents or mistakes. These loans were deliberately approved, packaged, and sold as financial products to investors around the world. Wall Street called them safe. Rating agencies esteemed them as reliable. Executives collected bonuses based on short-term profits, not long-term consequences. Then reality hit. Home prices stopped rising. Payments were missed. The entire structure collapsed under its own weight. What followed was economic devastation. Families were evicted from homes they had lived in for decades. Retirement savings vanished almost overnight. Small businesses shut down. Unemployment exploded. And for many Americans, recovery took years, not months. But while people were told to tighten their belts and accept responsibility, the banks were declared too important to fail. The U.S. government approved massive bailouts, injecting hundreds of billions of dollars directly into financial institutions, not as punishment, not as temporary control, as rescue. Executives were not handcuffed. They were protected. Many kept their positions. Some even walked away wealthier. The lesson was silent but clear. When the system breaks, accountability flows downward, not upward. After 2008, a new phrase entered everyday conversation. But very few people stopped to think about what it actually meant. Too big to fail. On the surface, it sounds like a technical warning. In reality, it is a promise made to the most powerful institutions in the economy. It means certain banks are so large, so interconnected, and so deeply woven into the financial system that their collapse would threaten everything else. So governments make a choice. They don't ask whether these institutions deserve to survive. They ask whether the system can survive without them. And the answer is usually no. This is where the rules change. In a normal market, failure is supposed to remove bad actors. But when banks are too big to fail, failure is no longer allowed. Losses are absorbed by the public through bailouts, emergency programs, and central bank intervention, while profits remain private. This creates a dangerous incentive. Banks are encouraged to take greater risk, knowing that success brings massive rewards and failure brings rescue. Risk becomes a calculated strategy, not a threat. Meanwhile, ordinary people live under the opposite rules. Miss a mortgage payment, miss a credit card bill, fall behind on rent. There is no bailout waiting. no emergency rescue. The system that protects institutions shows zero mercy to individuals. This is not fairness. This is asymmetry built into the design of modern finance. The most powerful part of this system is that it makes people pay without ever sending them a bill. When governments rescue banks, the money doesn't come from nowhere, even though it often feels that way. It comes from debt, money creation, and long-term inflation. Central banks inject liquidity into markets, interest rates are manipulated, and the money supply expands. On paper, this stabilizes the system. In real life, it slowly erodes purchasing power. Prices rise year after year. Rent increases faster than wages. Healthcare becomes more expensive. Education costs explode. Savings accounts lose value while assets like stocks and real estate surge. This creates a quiet transfer of wealth. Those who own assets benefit. Those who live paycheck to paycheck fall behind. You didn't vote for the bailout. You didn't sign off on the risk. But you pay through higher living cost, weaker currency, and shrinking financial security. This is why so many people feel like they are working harder but getting nowhere. The game didn't become harder. The rules changed in favor of those already inside the system. This cycle did not begin in 2008, and it will not end with the next crisis. The savings and loan collapse, the dot-com bubble, the housing crash, and the pandemic market rescue all followed the same pattern. Panic spreads at the bottom while calm decisions are made at the top. Markets recover faster than people because markets are protected. Asset prices rebound because capital is defended. Workers, renters, and savers are left behind because they are replaceable. This is why inequality widens after every crisis, not because people suddenly stop working hard, but because the system is designed to shield institutions first. Money influences policy. Banks fund lobbying. Regulations are shaped by the very industries they claim to control. This doesn't mean individuals are powerless, but it does mean awareness is no longer optional. In a world where banks don't lose and people do, understanding how money, debt, and power truly function is a form of protection. So if this video helped you see the financial system more clearly, take a moment to like it and subscribe to the channel. Because these stories aren't just history, they are warnings. And the more you understand them, the harder it becomes for the system to quietly take from you again.